Okay, so let's begin. Chapter 4, Credit Risk. Which company should have the highest credit risk premium? A. Company A, which has a rating of AAA, or Company B, which has a rating of BBB minus, or Company C, which has a rating of BB, or Company D with a rating of D. So, highest risk premium means highest risk, because the higher the risk of an investment, the higher the premium, which is the return on top of the risk-free. The higher their premium, the higher their expected return for the investor. So which of the following is the highest risk? D is the highest risk. So the expected return, which is the risk premium, will be higher for this investment. In relation to counterparty credit risk, the probability of default of a borrower measures A. Future exposure at point of default, B. Likelihood of failure to pay what is owed, C. Percentage factor applied to other outstanding loans, D. Possibility of decrease in credit quality over time. So the future exposure at point of default, this is called the exposure at default. The likelihood of failure to pay what is owed is the probability of default. And the percentage factor applied to other outstanding loans, most likely the loss given default. Possibility of decrease in credit quality over time, nothing here. So the answer is B. Which of the following credit rating changes would you expect to lead to a reduction in the cost of borrowing for a company? A. Bond A's rating changes from BB to B. B. Bond B's rating changes from BBB to BB. Bond C's rating changes from A to BBB. Or Bond D's rating changes from BBB to A. So a reduction in the cost of borrowing means a lower coupon. And usually a company will pay a lower coupon if it has a higher rating or when it's upgraded. Usually it doesn't change when it's upgraded, but it can withdraw the existing bond and then issue another bond at a lower coupon because its credit rating has been upgraded. So which of the following is an upgrade in credit rating? So A, B, and C are a downgrade. D is an upgrade. So the answer is D. So an investment fund has £100 million of stock out on loan and requires its lending agent to maintain a haircut of 5%. The collateral posted is short-term government bonds that are currently valued at 2.5 million and certificates of deposit valued at 2 million. Given the current value of the instruments, how much additional collateral should be posted? A. 0.5 million, B. 2.5 million, C. 3 million, D. 5 million. Okay, so the haircut is 5% of the loan. How much is the loan? It's 100 million. So 5% of 100 million is 5 million. So that's the haircut, which is sort of the required collateral. But the client has already given a collateral of 2.5 million in the form of government bonds. So the client already gave 2.5 million in bonds and 2 million in CDs. So out of the 5 million required, the client already gave 2.5 million. So the client already gave 4.5 million out of the 5 million required, which means there is an additional 500,000 required to be posted. So the answer is A. Which of the following is most exposed to issuer credit risk? A broker opening a new client account. B, a corporate bond fund. C, a private bank offering global services to private clients. D, an IFA providing financial advice. Right. So issuer credit risk, that's a corporate bond fund, because the fund invests in corporate bonds and corporate bonds are issuer credit risk. In which of the following scenarios does counterparty risk arise? A borrower does not meet a margin call on a stock loan. B, a company encounters financial difficulties and suspends payments on its bonds. C, a company fails to pay a bond maturity amount on time. D, a company misses a coupon payment on a bond. So all of these are different types of credit risk. But the question is asking of one particular type, which is counterparty. And the answer is A. So these are all also credit risk, but they are issuer credit risk, whereas A is counterparty credit risk. So the answer is A. A derivative dealer sets credit limits for counterparties with which it transacts business. Why does it do that? A, to ensure an acceptable level of diversity in the credit it is given. B, to reduce the exposure it has to major debtors. C, because it is a regulatory requirement. D, as a check that counterparties do not overstretch themselves when entering into transactions. Right. So all of you are wrong. A derivative dealer sets credit limits for counterparties. It's not talking about major counterparties or minor counterparties. So all of you are saying B, to reduce credit exposure. No. Now, keep in mind that this is a derivative dealer that extends credit. So let's give you a quick example about what this is talking about. So let's say the available credit that it has as a derivative dealer, available credit is $100 million. Now let's suppose that this derivative dealer gives this credit to two clients, each one 50-50. Its credit limits are $50 million. So the credit limit is $50 million. So it can extend to two. Whereas if this derivative dealer has a credit limit, it reduces, it sets limits, it reduces the limits to, let's say, 10 million. If it has a available credit of 100 million and its credit limit is 10 million, it can extend it to 10 different clients. If it has a credit limit of 5 million, it can extend it to 20 different clients. If it has a credit limit of 1 million, it can extend to 100 different clients. So setting different credit limits allows you to diversify, because the lower credit limits you extend, the more credit that it's available and the more you can diversify. So the answer is A. Here it says to major debtors. So it doesn't set credit limits to minor. Besides, this is a derivative dealer that extends credit. So there's always a limit on how much credit you can extend. And you have to play around limits based on that. So if you can give only 100 million, so in order to diversify, you have to reduce the credit limit you give to all of your clients. If institutions B and C purchase bonds from D, and then B enters into a credit default swap with institution A, who will get paid if D defaults? A is paid by B, B is paid by A, C, as it did not enter into any credit default swap, no one, as the bonds have no value since D has defaulted. Okay, so B and C purchase bonds from D. So D is the issuer of bond, issues the bond, and who buys it? So issues the bond, and who buys it? B and C buy the bonds. And then B enters into a credit default swap with A. So D enters into a credit default swap, which is a type of insurance, with A. So B is buying insurance, and then A is promising compensation, right? Because A in this case is the insurance company. B, because it entered into bought a bond, there is a risk that the bond might default. So B goes into an insurance contract as a CDS derivative with A, where A promises to compensate B in case the bond defaults. So who will get paid if D, the issuer of the bond, defaults? A will pay B. So the answer is B. B is paid by A. The expected loss for a bank's loan, where the probability of default is 12%, the exposure at default is 500 million, and the recovery rate is 60%, what is the expected loss? You have 30 seconds. Okay, so the expected loss equals to the probability of default times the exposure at default times the loss given default. So what's the probability of default? It's 12% times the exposure at default is 500 million times the loss given default, which is the amount that you will lose less the collateral. So the recovery rate is the collateral, because you will use the collateral to recover the loan, right? But you can only recover 60% of the loan. So the loss will be 40%. That's the loss given default. So the loss given default is 40%. Right? So it's 12% times, what's 40% of 500 million? It's 200 million. And what's 12% of 200 million? That's 24 million. So the answer is A. The credit risk of specific borrowers can be mitigated at the individual level by using asset securitization, or a futures contract, or loan sales, or netting. Right? So securitization, derivatives, and loan sales, these are credit mitigation techniques at the portfolio level. At the individual contract level, we have netting, we have collateral, we have credit limits, we have underwriting standards, and so forth. So netting, collateral, credit limits, and underwriting standards are used on the individual level. So the answer is D. Which type of input to a Hisham, can you please share some questions about netting? There is a lot of questions on the portal on netting in chapter 4. Which type of input to a credit score would be classed as an extraordinary input. A, cash flow. B, court action. C, debt capacity. D, governance. Okay, so when we are looking at credit scores, in order to give a client a credit score, we look at financial inputs. And example of this are cash flow and debt capacity. That's the first thing we look at. The second thing we look at is are non-financial inputs, the governance in the company. And the third thing we look at is court action. Sorry, the third thing we look at is extraordinary inputs. An example of that is court action. Which one of the following techniques may be used by institutions to evaluate the creditworthiness of borrowers? A, asset securitization. B, delivery versus payment. C, netting. D, underwriting standards. Right, in order to evaluate the creditworthiness of a borrower, we need to look at the borrower's financials. And that is part of the underwriting standards. A bank has accepted equities and bonds of a company as collateral against the counterparty defaulting. If the counterparty's financial position deteriorates, this is an example of concentration risk, liquidity risk, market risk, or wrong way risk. So, let's say company A takes a loan from a bank, and in return for the loan, the bank took a collateral, and the collateral were shares of company A. So the bank took shares from company A as collateral. In case company A doesn't pay the loan, the bank will sell the shares and recover its debt. The problem is, if company A's financial position deteriorates, that means there's a less chance, that means there is a higher credit risk. Because company A's financials are getting very bad, there's a chance that they might default on the loan. This creates another problem for the bank, because if company A is doing badly, the value of the shares goes down. So not only does the credit risk go up, the value of the collateral goes down. This is what we call wrong way risk. You take a collateral, usually shares of the company, The companies start doing badly, so the loan you've given the company, there's a chance it might not be paid. Also, the collateral you've taken loses value. It's put you on a double risk. In which of the following scenarios does issuer risk arise? A company misses a company payment on a bond, a coupon payment on a bond. B, an investor does not meet margin call on derivatives trading account. C, an investor fails to pay for a purchase of shares through the broker. D, one party to a stock lending agreement goes into liquidation. This should be easy. So A, this is issuer risk. So that's the right answer. But let's continue with the others. An investor does not meet a margin call on a derivatives trading account. This can be considered as a counterparty risk. An investor fails to pay for a purchase of shares. This is considered to be a settlement risk. One party to a stock lending agreement goes into liquidation. It's also called if it goes into liquidation, then that's a pre-settlement risk. But the question asks for issuer risk, so the answer is A. Which one of the following techniques identifies the difference between the interest rate paid on a borrowing and a default-free security? A, credit exposure. B, credit limit. C, credit rating. D, credit risk premium. Right. So the difference between your borrowing and your risk-free is called risk premium. The amount you pay or you risk over the risk-free investment or security is called the risk premium.